Client Portfolio Manager at Alphinity. Today I have Stuart Welch with me. He's one of the domestic portfolio managers, and today it's a new year and we'll be talking about the outlook for 2026. So welcome, Stuart.
Thanks, Elfreda.
As a starting point, in our current monthly, we've mentioned that we are quite constructive on the outlook for Australian equities going into 2026. Can you give us a few reasons why that is the case?
Sure. So the key reason there is that we've actually seen an inflection in the earnings upgrades or revisions for the market. And so after 3 years of persistent earnings downgrades, where we started out expecting 8.5% earnings growth for the market and actually ended up delivering negative earnings growth, we've actually started to see earnings expectations for the market increase. And that's been quite narrow. It's really been driven by the resources sector, and the financials continuing to contribute to that. But we are finally in a market where we're seeing earnings upgrades.
Now, definitely exciting looking at the outlook here in Australia relative to where we've come from. If we delve a little bit deeper into those sectors that will be giving us the earnings growth, I know we talk about the resources sector, things looking up for the first time in a while. Can you talk to just our view on that sector and how we are positioned?
Sure. So we're reasonably constructive on the outlook for the resources sector, and we're seeing strength in commodity prices, and we see potential for further earnings upgrades. We've already had quite a few to date in the resources space, but we see potential at current spot prices for further earnings upgrades, and that strength is really being driven by a global demand that's probably better than what people expected, some supply constraints, a weakening US dollar, and obviously you can't forget just people's expectations had been battered down after a few years of earnings downgrades. And so for those reasons, we have already seen some earnings upgrades in the space and continue to see those coming through. We're particularly optimistic on some of the base metals, so things like copper and aluminium, where we see good earnings upside. We're also constructive on the iron ore side, where we think things could be a bit better than what people expect. And also lithium, driven by the strength of demand for EVs, but also particularly for the grid in China, for example, as well.
And our positioning is across those sort of bigger diversified plays, BHP, as well as a few smaller commodity stocks.
Yeah, that's right. It's a combination. So I think as we've seen those earnings upgrades come through, really the sort of commodity specific stocks really led, those more leveraged to those upgrades led. But we are seeing the diversified miners, and expect the diversified miners, the large diversified stocks like BHP and Rio, to continue to participate and catch up ultimately as well.
So if we pivot to the other side of that coin, you've increased resources exposure quite substantially. What's on the other side of that? Which sectors did you reduce, and what has happened to the banks specifically? Sure,
I think that's a very good question. So in any rotation, as we've seen into the resources space, the funding needs to come from somewhere. So the flip side of the coin is always what is being sold to fund that. And I think in the main, you would say that it's really been stocks that have disappointed and some of the more expensive long duration growth stories. So the two sectors in particular that have been sort of most impacted would be the technology space and also the healthcare space, where you've seen quite a few of those stocks disappoint, but also on relatively elevated or lofty price earnings multiples, and so they've certainly been under pressure. I think coming into this, the logical expectation was that the banks would be a large part of the funding. That was a sector that has done particularly well over the last couple of years, and so people thought that would be the case. And to some extent it has been. I think CBA certainly has been a bit of a funding source. But if you look at the other three banks, major banks that have continued to have pretty good earnings outcomes, they've actually been some of the stocks getting better earnings upgrades in the market. They've continued to perform pretty well. And so in the main, in aggregate, it hasn't really been the banking sector that has funded this resource, although you have seen some differentiation within the sector based upon who's been getting earnings upgrades and doing well. And so stocks like NAB, Westpac, where, for example, we have our exposure in the banking sector, have continued to perform reasonably well. Where stocks like CBA, for example, that's had pretty lackluster sort of earnings revisions over the last 6 months, and is reasonably expensive, has certainly been one of the funding sources for the rotation.
So one of the important factors that we look at is that sort of idiosyncratic earnings growth story, bottom up, stock by stock. So if we just refer back to the technology and healthcare sectors, you mentioned that that's where you have reduced specifically, but are there any players in that space that you still like for 2026?
Yeah, that's a very good question. So ultimately we're looking for a bunch of stocks that are continuing to get earnings upgrades and outperform expectations and reasonably valued, and even in sectors that in aggregate are under pressure, we can often find those opportunities. And so stocks like ResMed, for example, in the healthcare space, we're constructive on. We still think the volumes and demand for CPAP, for treating sleep apnea, are still there, and there's further margin upside as well. And likewise in the technology space, while the sector has been under immense pressure to fund this rotation, there's still stocks like Technology One, for example, which we're constructive on. We think they've got strong demand for their enterprise software, both within the sort of education and local government space. And there's further growth opportunity through bringing new products and modules to market for them as well. So a couple of stocks, even in some of those out of favour sectors, that we still think there's opportunity.
Great. Well, thank you, Stuart, and all the best to our clients for the new year ahead. For more information from Stuart and the team, please visit us on alphinity.com.au. Have a look at our monthly notes as well as the Insight section for a more detailed Australian market outlook. Thanks.